All right, let's get right into it. We're going to be looking at a company that is, and I mean this, absolutely critical for, well, for the future of pretty much everything tech and green energy. But its stock has been on a total roller coaster. So the big question we're trying to answer today is pretty simple. Is Lynas Rare Earths a buy right now?
So, before we can even talk about Linus, you've got to understand rare earth elements. These aren't just some boring minerals you dig out of the ground. They are the absolute lifeblood of the high-tech world we live in. Those incredibly powerful magnets inside electric vehicles, the massive generators and wind turbines, and yeah, the tiny little components that make your smartphone work, they all need rare earths.
And here's the kicker. In that entire critical global supply chain, there's one company that really stands alone, Lynas Rare Earths. They are the world's only major producer of these separated rare earth materials at scale that is completely independent of China. I mean, think about that. It gives them this almost unbelievable strategic importance on the world stage.
But, having that kind of power doesn't make you bulletproof. Not at all. After a really turbulent year of huge spending, some operational headaches, and, well, some frankly shocking financial numbers, investors are asking a pretty tough question. Is this company a golden opportunity, a chance to buy into a vital asset for the future? Or is it just way too risky right now? Let's break it all down. Okay, first up, let's look at the bull case. These are the powerful arguments for why you would want to invest in Lynas. And really, it all boils down to their unique spot in the market.
I mean, this slide really lays out their competitive advantage, their moat. They aren't just some mining company. No, they are a fully integrated producer. They have a world-class, super high-grade deposit at a place called Mount Weld. They've proven they can operate at a low cost, and this is huge. Western governments see them as an absolutely essential partner for securing their own tech supply chains. In today's world, that is a massive, massive advantage.
And check this out. Despite all the financial drama that we're about to get into, look at their production. Their output of NdPr, that's the key stuff for the super strong magnets in EVs and wind turbines, it's actually growing. This tells you that operationally, the core engine of the business is still running and, in fact, it's ramping up.
And here's the foundation for all of this, the long-term security. That Mount Weld mine, it's not running out of juice anytime soon. They've got a confirmed mine life of over 20 years, even with their new expanded production rates. So this isn't some flash in the pan. It's a long-term strategic resource. Okay, so that all sounds pretty great, right? A strategic monopoly with a long-life asset. But as we turn the page and look at the financials, well, the picture gets a lot more complicated. This is where the story takes a really dramatic and, for a lot of people, a very concerning turn.
And, there's just no way to sugarcoat this. The last full-year results were a complete bombshell for the market. I mean, from a distance, things looked maybe okay. But once you started digging into the details, yeah, it was a totally different story.
Just look at these numbers. Sales revenue, hey, it's up about 20%. Fantastic, right? But then you look at the net profit after tax. The actual bottom line profit, it absolutely collapsed. It went from over $84 million down to just $8 million. And their cash in the bank, it fell from over $500 million to just $166 million. It's a staggering contrast.
And this is the question that has every single investor scratching their head. I mean, how on earth do you manage to sell more stuff but make 91% less profit and burn through that much cash? It just seems to defy all business logic.
Well, here's the answer. The profit didn't just disappear into thin air. It was eaten alive by the enormous cost of growth. See, Lynas has been in the middle of this massive investment cycle, building brand new processing facilities in Kalgoorlie and expanding Mount Weld. And those projects come with gigantic ramp-up costs, new equipment that you have to depreciate, and of course, operational hiccups. Then you throw in what they call significant uncertainty about their planned U.S. facility, and you've basically got a perfect storm of expenses just hammering the bottom line. So with profits crushed and cash getting low, how does a company like Lynas power through this? Well, they're not just sitting on their hands. They have made a massive bet on their own future, and it's a bet that's now backed by a huge injection of cash. And this is the answer to that cash burn problem. The company just went out and raised a $750 million. That's $750 million. This move completely changes their financial picture overnight.
It gives them a strong balance sheet to not only survive the storm, but to really go on the attack and chase their growth plans. And they've got a very clear plan for where that money is going. They're calling it the Towards 2030 strategy. It's actually a pretty simple two-step approach. Step 1, harvest. Basically, get those brand new facilities they just built running at full speed and actually making money. Step 2, grow. This is about expanding their resource base, and this is the really exciting part, moving further down the value chain into making rare earth metals and even magnets themselves. And you can see right here where that capital is pointed. The biggest slices of the pie, over $500 million combined, are going straight into increasing their processing capacity and getting into that metal and magnet supply chain. This tells you it's not just about digging more dirt out of the ground. It's about capturing more and more value from every single kilogram they process.
All right, so let's pull this all together. What we have here is a company with a strategic advantage that is frankly undeniable. But it just went through a period of incredible financial pain to fund its own future growth. So what's the final call? What should an investor do?
So here it is, the whole story in one place. The bull case is all about that unique market position, the government support, and the fact that the really painful, expensive part of their investment is now mostly done. The bear case, on the other hand, is all about those terrifying recent financial numbers, the cash they burn through, and the risk that they just can't get these new, complex facilities running smoothly. After weighing all the evidence, looking at the bull and bear cases from the source materials, the final verdict is a buy. But, and this is a big but, it comes with a very specific reason why. Here's the thinking. That punishing investment cycle, it's pretty much over. That shocking drop in profit, it's not a sign of a broken business. It's the temporary and, frankly predictable, cost of a massive expansion. At the end of the day, Lynas is still a one-of-a-kind strategic asset that the world desperately needs. And now, with $750 million in the bank, they have the financial firepower to go out and execute their plan and capture all that future growth. But let's be absolutely crystal clear about the single biggest risk here. It all comes down to one word: execution. The strategy is solid, the funding is in place, the market demand is there. But can the management team actually ramp up these new, very complex facilities to full production, do it on time, and do it profitably? That right there is the billion-dollar question that will decide whether this big bet ultimately pays off.